We are with our featured guest, Ken Curtis, chairman at Starford Investment Holdings. If the United States really starts to get 3 to 4% growth, their interest rate environment's moving higher. That flows over to Canada, puts downward pressure on our economy. Will we see the governor of the Bank of Canada just talk down the interest rate environment, and therefore we're still going to be okay? How do you see that playing out?
If the U.S. economy is growing at 3 or 4%, our economy is going to be growing faster as well. And the world economy is not picking up strongly, but there's a general pickup across the world. So there will be pressure over the next 12 months, if that's the scenario that unfolds, on the Bank of Canada to raise rates. And they have a trade-off that they can look at. Either we raise rates or we let the Canadian dollar fall some, or some combination of both. I'm predicting that we'll see a substantially lower Canadian dollar, which in the context of a U.S. border tax and a U.S. energy independence policy would be good for our energy producers, because it will allow them de facto to cut their costs, because their costs would be in Canadian dollars, their revenue would be in U.S. dollars. So that would help the economy as we go through this pressure. One sector I think we have to watch very carefully is the real estate sector, the residential real estate sector. Canadian households have the highest debt levels relative to income ever. And as interest rates go up, obviously mortgage rates will be adjusted, and that will be a very big hit on households. And then that will push down consumer spending, which will then tend to weaken the economy. So this is not going to be an easy transition in the next 18 months.
Ken, a lot of people do say, though, that the Canadian housing environment, because of our banking system, which isn't what you're talking about. You're talking about, look, people just can't afford a higher mortgage rate. That's essentially what we're really talking about. But people will say, look, there's no relationship between what happened in the United States and what could happen here in Canada. It doesn't sound like that's your view.
Oh, quite the opposite. I mean, we export 25% of our GDP to the United States. I think the government has 10 priorities. The first 8 are the United States. Number 9 is maybe Europe, and number 10 maybe is China.
Okay.
But I think they are fully focused on this because this is our number 1 issue.
Housing.
The United States and its impact on us. Housing is highly over-levered at the moment. Prices are very high. I met someone the other day. They're commuting from London, Ontario to Toronto every day. Almost 2 hours.
Right.
4 hours commute. Imagine 20 hours commute because they can't afford to live in Toronto. That's the mess we're in. And higher interest rates will bring some of those problems right to the surface.
When we take a look at the rest of the world, more and more people have been saying, look, it's almost as though we're seeing a synchronized global growth picture. Do you agree with that?
It's not a strong uplift, except in China. But yes, we are seeing Europe is doing a little bit better. Even France is doing better. Even Italy is doing better. The UK will be in a problematic situation until we get through the Brexit negotiations. Southeast Asia is doing well. It's coming back nicely. India, 7-8% growth. China, a very solid 6.5% growth. The last quarter, corporate profits up 31%. Yes, we're in an environment now where the whole world is lifted. And I think that's great for us because we're an export nation.
Do you see that we will have increased volatility because of the negotiations that have to take place between Brexit and EU?
The negotiations are extremely complicated. The UK has never negotiated anything like this in the last 40 years. In fact, all of the trade negotiations in EU context are done through Brussels. So they're hiring people left, right, and center. They've already hired 2,000 people to go on this team of negotiations. But it's not just the direct negotiations with the EU that are in consideration here, but all the changes that have to occur in UK legislation as a result of leaving the EU. Plus, they want to have a good negotiation with the EU. They want to still keep good access to that market. But if they have a bad negotiation or it doesn't work out that way, they're going to be behind a huge tariff wall facing many countries. So at the same time, they're trying to negotiate free trade agreements with around 15 countries, the US, Canada, Australia, Switzerland, China. Plus, the government has its own political agenda it wants to get adopted before the elections in 2020. So the UK has an agenda that is massive, and a lot of things could go wrong. So I expect a lot of volatility in the pound as we go through. The pound to drop relative to the euro.
So what does this mean, bottom line? There's a lot of different dynamics going on, of course, but for you and investing, where do you want to invest and what do you really want to avoid right now?
I think it's problematic to be long bonds at the moment. Maybe you get a pop of bonds prices once in a while, but the underlying trend I see is to lower bonds. So I continue to be short German bonds and generally be very careful about bonds. Stocks, I still think that stocks will do better. We're having a little bit of a correction now. I'd like to see this correction go further to take some of the froth out of the market, come back to a more solid base. And then I think we're going to move ahead again, another big step in the stock market.
Does that mean you believe Trump's reflation trade and the Trump trade?
Trump trade's backing the
It is backing
reflation
down,
off
but do you think it's
a
coming
bit.
back?
I think it'll come back as we
Okay.
come back to more deregulation, more tax cuts, more about infrastructure, and more about repatriating profits that have been held abroad.
Doesn't sound like you're invested heavily in Canada.
Unlike many, I'm not afraid of the resource sector. I think stronger world growth means a better picture for natural resources. There's lots and lots of cheap energy plays in Canada. If we get a lower dollar, Canadian energy producers keep cutting their debt and try to lower their costs, they'll do just fine.
And you've said in the past that with respect to the Canadian dollar, you thought it was going to go lower when I think we were talking maybe it was around 80 cents. I can't remember the exact number, and it certainly did go lower. But can it go lower from here? We're 74, 74. Where do you see it going?
My ultimate midterm target for the Canadian dollar is 62 cents to the US dollar.
62.
I see in this trade-off between raising interest rates and a lower dollar, we will see over the next 18 months through to 2018 the Canadian dollar go well into the mid-60s and below.
Ken, we'll leave it on that note. Always great to see you and get your views. Thank you very much. Thank you.
Pleasure.